One man requested 1,000 shares of SpaceX. Someone else put in for 75 shares and walked away with 11. While these people were still refreshing their brokerage apps waiting to find out how little they were going to receive, the pension funds, the hedge funds, the sovereign wealth funds, all of them had already been allocated, confirmed, and in some cases were quietly doing the math on when to sell. The whole thing is almost impressively brazen when you think about it, and the reason it works is that most people genuinely don't understand how IPOs actually function. They see the headlines, they see a rocket launch and a $1.77 trillion valuation, and they think they're getting in early. They are not getting in early. In fact, and this is the part that should genuinely make you annoyed, by the time you're allowed to buy in, the people who were actually early have already made most of their money. There's a story that gets told a lot about public markets, and it goes something like this. The stock market is the great equalizer, the one arena where the small investor and the big institution supposedly compete on level ground. When Amazon went public in 1997, it was a small, genuinely uncertain online bookstore with a $438 million valuation. You could buy in at $18 a share, and the company still had essentially its entire growth story ahead of it. When Google listed in 2004, the founders literally quoted Warren Buffett in the prospectus and structured the offering specifically to reduce the advantage large institutions had over everyday investors. But that era is basically gone. The average age of a company at IPO has gone from roughly 4 years in the early 2000s to closer to 10 years today. And the really big ones, the SpaceXs, the OpenAIs, the Anthropics of the world, have been sitting in private hands accumulating value for decades. When SpaceX decided to go public, raising $75 billion on the NASDAQ under the ticker SPCX at $135 a share, it hired a group of underwriters: Goldman Sachs, Morgan Stanley, Bank of America, Citi, JP Morgan, and these banks spent weeks running what's called a roadshow, which sounds glamorous, but is essentially a series of private meetings where SpaceX executives pitched the deal to large institutional investors long before any of it was public knowledge. The pension funds and hedge funds that attended these meetings got to ask their questions, review the financials in detail, and decide exactly how much they wanted before retail investors even knew the deal was happening. The IPO price is then set based on that institutional demand, and once the price is set, shares get allocated to the band. K's best clients first, the ones with the longest relationships, the ones who generate the most in fees across other products. Now, SpaceX did make a point of reserving 30% of the IPO for retail investors, and the press treated this like a great act of generosity. But here's the math that those headlines skipped. SpaceX only sold 4.3% of the company in the first place, which means 30% of 4.3% is about 1.3% of SpaceX available to the entire retail investing public. And with over $100 billion in retail demand chasing roughly $22 billion in retail shares, the person who got one share wasn't unlucky. They were just participating honestly in a system that was never designed to give them more. And there's another mechanism built into this structure that almost nobody mentions when they're talking about IPO excitement, and that's the lockup period. When SpaceX went public, the early employees, the early venture capital investors, the people who had been holding private shares for years, none of them were allowed to sell for 180 days after the IPO. That's a legal restriction. And the effect of that restriction on day one is that the supply of available shares is artificially compressed, which pushes the price up in a way that looks like market enthusiasm but is partly just a supply constraint that disappears 6 months later. SpaceX opened at $150 on its first day and closed at $161, which is a 19% move. And if you were allocated shares at the IPO price of $135, that looks like a win. But if you saw those headlines and bought SPCX on the open market at $161 because you didn't want to miss out, and this is the part that the data really doesn't let anyone argue with, you were buying into a dynamic that has historically produced very bad results. Jay Ritter at the University of Florida has tracked IPO performance across thousands of DECDI, all since the 1970s. And investors who buy at the first day close have seen average market-adjusted returns of negative 20.5% over 3 years. Here's the uncomfortable reality that ties all of this together. The IPO is not a gift to the public, and it was never designed to be. It is a liquidity event for the people who are already there, and the public market, meaning you, meaning the retail investor, is the buyer those early participants have been patiently waiting for. The issue is the framing. The IPO gets sold to the public as an opportunity to get in early, when functionally it is an opportunity to buy out the people who got in earliest. SpaceX went public at $1.77 trillion. SpaceX might absolutely be a generational company. Starlink alone is a compelling business, and the case for the long-term vision is real. But at a $1.77 trillion entry price, you are not buying the company as it exists today. You are buying years of near-perfect execution that hasn't happened yet. And if it doesn't happen, the people who got out at the IPO still got out. None of this means IPOs are something you should automatically avoid, or that every one of them ends in disaster for retail investors. What it means is that you should be honest with yourself about which position you are actually in when you participate. If you are allocated shares at the IPO price, you have a genuine, if narrow, advantage, at least for the short term. If you are buying in the open market on the first day because the headlines made you feel like you were missing something, you are not getting in early. You are getting in last, and you are doing it at the precise moment when every person who was actually early is now legally and practically positioned to sell to you. The architecture of this system was not designed to be fair to retail investors. It was designed to serve the institutions that generate the most revenue for the banks running the deal. That's not a conspiracy. It's just how the plumbing works. And the only real edge available to anyone operating outside that system is understanding the plumbing well enough to not be surprised by what comes out of it.